Hey there, financial adventurers. Welcome back to XTRM Finance, the channel where we turn tax talk into something you'll actually want to listen to. Today we're tackling one of the most confusing yet crucial topics out there, marginal tax rates versus effective tax rates. Think of it as the Beyoncé and Jay-Z of the tax world. They're a power duo, but they play very different roles. Let's break it down. Alright, let's start with the marginal tax rate, aka the diva of taxes. Picture this staircase. Each step is a tax bracket, and the higher you go, the more taxes you pay on income within that step. Your marginal tax rate is the tax rate you pay on your last dollar earned. It's like ordering dessert after dinner. You're paying the premium because you've already had your fill. So if you're in the 22% tax bracket, your marginal tax rate is 22%. But, and here's where it gets spicy, that doesn't mean Uncle Sam takes 22% of all your income. Oh no, he's picky. Enter the effective tax rate, the chill sidekick who tells you what you're actually paying in taxes. This is the percentage of your total income that goes to taxes, considering the lower rates you paid on your first dollars earned. It's like averaging the cost of appetizers, entrees, and dessert instead of just looking at that pricey cheesecake. For example, if you earned $80,000, only a portion of that is taxed at 22%. The rest gets hit with lower rates, like 10% or 12%. Your effective tax rate is usually lower than your marginal rate, so breathe easy. Uncle Sam's not taking everything. Okay, so why should you care about the difference? Knowing this can help you make smarter financial moves. For instance, your marginal tax rate helps you decide if contributing to a tax-advantaged account, like a 401k, is worth it. Spoiler, it usually is if you're in a high bracket. Your effective tax rate gives you the big picture. It's what you use to figure out how much of your paycheck actually ends up in your wallet, and not in Uncle Sam's. Retirees, listen up. Understanding these rates can help you strategize withdrawals from tax-deferred accounts and minimize taxes. Here's a common myth. If I earn more, I'll lose money because I'll be in a higher tax bracket. False. Only the income in the higher bracket gets taxed more. Your old income stays at the lower rates. It's like getting promoted, and worrying your first paycheck will retroactively get taxed higher. Total nonsense. Let's bring this to life with an example. Say you make $80,000. Here's how it breaks down. First $11,000 is taxed at 10%. That's $1,100. Next $33,725 at 12%. That's $4,047. Remaining $35,275 at 22%. That's $7,760. Add that up, and you've paid $12,907 in taxes. Divide that by $80,000 and your effective tax rate is about 16%, not 22%. Boom. Knowledge is power. Now that you're a pro, here's how to put this knowledge to work. Use that marginal rate to max out 401k IRAs or HSAs. Future you will thank you. Getting a bonus or selling stocks? Know your marginal rate so you can brace for the tax hit, or reduce it with strategic deductions. Yes, even DIYers need help sometimes. A tax pro can make sure you're not leaving money on the table. So, what's the big takeaway? Your marginal tax rate shows you what's next, and your effective tax rate shows you what's real. Together, they help you make smarter financial decisions. If you found this helpful, or at least mildly entertaining, smash that like button, and share this with someone who needs a tax crash course. And don't forget to comment below with your tax questions. Let's make money smarter, together.